Okay.
Excellent. Ellie, thank you very much for the invitation, and thank you very much for setting up and organizing the seminar. The point of this seminar is basically to put the value of a early stage company in context. The intention of this seminar is not to talk about some new theory, but to talk about framing the valuation in the correct settings. In particular when it comes to early stage companies, but also to companies based here in Bulgaria. I will start with a couple of slides initially presenting our fund. I will go over these slides very quickly, and then I will set out the macroeconomic framework currently. I don't know whether you guys are aware, but there is a Federal Reserve decision that we are kind of awaiting today. I don't have the TV in front of me. And after this, I will set out the return profiles of a risk-free investment and a venture capital investment. And from there, taking the macro picture, taking the return profiles, we'll try to develop a very simple, it's a really very simple model, how to look at an early stage company. And after that, we can have half an hour discussion, questions, whatever. So I am a partner at Sofia Angels Ventures, which is an early stage co-investment fund. Hold on, why doesn't it? Yeah. Briefly, our fund is 13 million euros. We have invested about 35% of the fund. We started in November 2020. We are focused on tech startups. We can invest globally pretty much, but 50% of the capital we have to invest in Bulgaria. And the main reason for this seminar, I've been talking to Eli for some time, is the Bulgarian market for tech companies, which I will present my hypothesis. The tickets that we invest, 200 to 500K, we need always private co-investors to participate with us. And I believe we are a very experienced team, 5 people, that we can deliver the deals that our investors expect to us. Roughly speaking, these are the parameters that we seek in a company. We try to determine whether we have a 10x potential, global scalability. If we can find a global product, that would be great. We'd like to have the company to have a financial business plan. It's not always the case, but if they have a financial business plan, that means they have thought about the business, not just the idea, but the business of the idea. Ideally, they would have intellectual property, a strong team, and we'll be addressing a very large market. So this is our fund, which at the moment is not the subject of this presentation. Now, about the macroeconomic situation here, and the point is the following. The interest rates currently in the major industrialized economies, the United States, the Eurozone, the UK, are going up. And that has actually quite important implications for the valuations and for the sustainability of early stage technology companies. I just want to point out that the interest rates now in Europe, with the 3 main facilities, are between 4 and 4.5%. The average inflation in the Eurozone is actually way above the 2% that these guys are targeting. But the European Central Bank can't raise interest rates too much, because then the disparity in the economies in the Eurozone will create problems. The thinking at the moment about inflation is still the kind of traditional old school thinking. We raise interest rates, we dampen demand, inflation goes down. The Eurozone growth projections are, I would say they're very weak. 0.7% for 23, and then in 25 it goes up to 1.5%. Compared to the dynamics that we see in the United States economy, this is really weak. The United States interest rate, the Fed interest rates, the Fed funds is 5.5%, and the yields on the US treasuries are again between 4.5%. So the interest rates, the yields, and the central interest rates in the US and the Eurozone are actually kind of comparable. And this is what I would call risk-free rate going forward. What are the implications for the higher interest rates? Theoretically, the high risk-free rate reduces the value of equity and the value of the enterprise. Enterprise value and equity value are two different metrics, but if a company has debt, they are different. If the company doesn't have debt, you can actually equate the two if there is little cash as well. The reason why this is the case is through the high discount rates. The risk-free rate has an effect on the overall weighted average cost of capital. But, and as I'm going to demonstrate, the much bigger cost currently that companies are experiencing is actually the opportunity cost for large investors, such pension funds, insurance companies, family offices, etc. A few definitions other than the academic ones is that, and I'd like to point out the sources here. I'd like to flag out the sources that I'm using in my presentations quite pedantically so that you guys can refer to these articles if you have interest. But rising interest rates means that companies themselves internally do not invest in R&D and CapEx as actively as they would do in a low interest or zero interest environment. VC-backed tech companies, especially the early stage companies, are very vulnerable to reduction in CapEx and R&D from larger corporations in turn. Smaller players, the companies that we all see in this club are very small early stage companies, and they are typically very specialized. An early stage company can present a sophisticated business model, but typically they start with one focused product. And in this case, they are very vulnerable to high interest rates. But there are two pieces of positive news, that the last two bullets. The first piece of good news is that the rising interest rates is not expected to have a dampening effect on the creation of new companies. So meaning that the interest rates may be high, but the supply, the creation of new companies is going to remain fairly dynamic. And that is good news. The second piece of good news, and I'm kind of encouraging you to look at this research paper. It came out maybe a week ago. This paper argues that the reduction in inflation, in particular that we are seeing in the United States at the moment, is not due to the increased interest rates, or the larger portion of reduction in inflation is not due to the high interest rates, rather to the improved supply situation. And I would argue that a big chunk in the improved supply situation are the technology companies that offer different services that provide better employee overview, they provide better benefits, they provide for efficient workflows, etc. So the high interest rates are problematic, but we have also good news in the current situation. Hold on. I'd like to also address here the difference between investing and speculation. That's actually an important difference, because quite often in the early stage, what we see happening is investors putting amounts 5,000–10,000 euros without doing the necessary type of work. That's okay if you're in a syndicate, but quite often doesn't happen like that. And the difference between investing and speculating is that the risk that you take is significant in the speculating part. Speculation is a little bit like gambling. Low risk investments in turn, actually, you do a little bit more analysis. You try to understand the investment situation you are getting in. This is important because, as I argue further down the slide, venture capital can be perceived both as investing, because we provide long-term growth capital, and because we do fundamental analysis, or at least we try to do fundamental analysis. And we also try to structure deals that protect the riskiness, the downside in particular for investors. But venture capital can also be seen as speculation, simply because it is based on the belief of explosive profits in the future. So we all invest in promising companies because we believe they're going to make us gazillionaires. We invest 5,000 euros and we expect to get 100 times return. That's close to speculation. I'd like to point out two other factors here. Investors do not believe that their companies will fail. I mean, if they believe that, they wouldn't be investing in a company. So typically, I'd like to make this, everybody that is on this call and the Angels Club and all the professionals we meet across the globe, they know that. But I'd like to bring it up to the front because it's an important part of actually using a simple valuation framework. We all believe the companies are not going to fail. However, the statistic is well documented, and you actually have about 50% of a large, well-selected portfolio of companies actually failing. Exactly which 50%, we never know. That's the trick. This slide underpins, and illustrates the current environment that we are in. These are the investment profiles of a risk-free investment. The top one, the risk-free return. And the bottom one is typically what you would expect a VC to have as a profile, returning the capital to the fund. The VC returns do not include the costs for managing the fund, such as management fee, transaction costs, etc. The two investments are equivalent. So what I have done is I have calculated the return profile of 100 euros invested at 4% for 10 years, risk-free. So the first year, you get 4% return, and then the return gets compounded. And in the 10th year, you have about 144 euros risk-free. You don't have to do anything. You have to buy government bonds, US treasuries in particular. I don't believe Europe has government bonds that yield with risk equivalent to the US treasuries. And then at the bottom, you have a VC return. I have again explicitly pointed this out because people are aware of this, but I just want to make the graphs comparable. You have 100 euros invested by a VC. The assumption that I have here is that every year the VC invests 20 euros for 5 years. This is a typical investment profile of a VC. So every year we have a negative cash flow of 20. And then after the 5th year, we expect to start harvesting or realizing the investments. And I have made the assumptions that two investments in 2 years are going to return the capital, no more. So in year 6 and year 7, we get 20 euros back without any return. Then in year 8, we get 4 times the invested amount. So we get 80 back. In year 9 and 10, we get nothing back. So this is kind of a 2 out of 5 fail. And the return profile of this VC investment is equivalent to the risk-free return. So as you can see on the graph, the VC investment is extremely risky. You have to do 4 times in one of the years, and you have to get from 2 of the years or 2 of the investments, if you like, your capital back. But getting the 4 times is actually never certain. Of course, the VCs and why people see this as a great opportunity is they bet on more than 4 times returning and not every company failing. If a VC fund manager manages to do that, so for example, if in year 8, instead of 4 times, the VC manager returns 10 times that investment, he's going to beat the risk-free return quite handsomely. But that is exactly the problem with our industry. Getting that 10 times from the couple 3 of your investments in order to return more than the whole fund that you have invested. And the way VC managers deal with this is actually expecting higher return on every investment that they make. So I'll move on to the next slide and try to present here a definition of the different stages of investment. Again, people are familiar with this, and I'd like to point out that these stages of investment, different VC funds define them differently. In our fund, we also have certain nuances. What is a seed stage? What is a startup stage? First stage, second stage. These definitions have been taken by a paper from William Zalman. It's called Valuing. I refer to this paper at the end of the presentation, and I strongly encourage you to buy this paper. It costs $8 from Harvard Business School, but it lays out in a very systematic fashion how typically to look at early stage companies, what are the challenges they face, how are the investors dealing with this, and how are the investors involved. And the most important thing is it provides a return profile for every one of these stages. So the bridge stage is the last stage before a trade sale or an IPO, for example, in this framework. At the seed stage, where the company is basically starting up with an idea, investors would typically seek 80% return per annum. The next stage is progressively the returns sought go down. The reason for this is that as a company progresses across the stages, it accumulates assets. So, for example, the second stage would typically Series B. The tech company or the early stage company has accumulated some assets, and it is still a very risky venture. It is still a high probability of failure, but the investment amounts from investors typically get higher, 5 million plus, and the return profiles actually, or the returns sought from investors go down. When I say the returns go down, I mean that the valuations of the companies go up. That's the relationship between a valuation and a return. If you seek a higher return, as we would normally do at the seed stage, that means a lower valuation. I will demonstrate this in the next slides. Now, having said that, I'd like to propose I'd like to present here a simple valuation method, which is based on the work of William Zalman and on his paper, A Method for Valuing High-Risk Long-Term Investments. And I'm not going to present something new here. Everybody is familiar, but what I'm presenting is the context and a slightly different way of looking at this very simple method. The purpose for this is that for early stage investors to get a kind of a different perspective on companies, instead of being a speculative mindset where, you know, a nice entrepreneur, a very sophisticated entrepreneur with a nice presentation, with seemingly great idea comes and presents, and you say, oh, great, this looks so good. The valuation is astronomical, but I still like, what I'm seeing. What I'm suggesting here is let's look into the future and let's be a little bit more rational. If we as investors, as angel investors in the early stage, can bring a little bit more rationality, taking into account the higher risk-free rate that we are seeing at the moment, and the characteristics of the different stages of the companies and the typical returns that investors would seek, we may be able to get a better idea of when we see a company and when the founders ask for 12 million euro valuations, is this reasonable or not? The method has roughly 5 steps. Typically, when we see a company, as I said, we would like to see a business model, because it's all good to have an idea, but it's important for an entrepreneur to have kind of a basic understanding, how much does my service or product cost? And in particular, where do I want to go 5 years down the line? 5 years here is just taken as an average number. You could put 6 years, 7 years, whatever. But 5 years is a nice average number, and we estimate an operating metric. In our example here, we are estimating EBITDA, assuming that the company will be EBITDA positive in 5 years. If you know that the company isn't going to be EBITDA positive in 5 years, then you might go up further the operating cost structure and estimate revenue, for example. So we take this operating metric in 5 years. I have a very specific example. It's actually one of our portfolio companies, which I'm not going to disclose the name of the participants, but it's a true life example that I'm going to showcase here next. As a second step, we determine the appropriate multiple 5 years down the line. And this is where actually the work of the financial investor, the good professional, comes in. If you take a revenue multiple, if you take an EBITDA multiple, you have to say, okay, how much is the EBITDA I'm going to pay for this company? If you have a NASDAQ comparable company that trades at 20 times EBITDA, the likelihood is that you are not going to like to pay 20 times for a company that is still early stage, doesn't have a product, and you are estimating 5 years going forward. You'd like to take less of a multiple, but doing the research, making sure what is a comparable company, what is reasonable multiple is extremely important for the operating matrix 5 years down the line. So you multiply the operating metric by the multiple, and you get the product called the terminal value. Now, the term terminal value is kind of widely used in doing financial valuations. It is widely used in the discounted cash flow model. And one important aspect is that the terminal value, in our case, represents all the value. At the moment, we are projecting the metric 5 years down the line. We are estimating a multiples 5 years down the line. And when we multiply it, we get something called terminal value, 5 years in the future. The company that we are looking at the moment doesn't have revenues. It may not have an even cost history, but we're estimating 5 years down the line. And then with this terminal value, we can do two things. We can bring the terminal value to present, or we can grow our investment amount 5 years into the future with the IRR that we are seeking. The example that I'm going to develop on the next page is doing the second thing. So we take the investment amount and we grow it by, in our case, 50% going into the future for 5 years. I would like to do that because this is going to tally nicely with our idea that we are investing in something into the future. And then the investment amount, as it is grown 5 years into the future, is calculated as percentage of the terminal value to give us the required ownership of the company that we would want to have 5 years down the line. Okay. So let me demonstrate this. And if you guys have questions, we can return to this page or to the next page, which is the numerical example. So I have taken a real life example from one of our portfolio companies. I'm not going to disclose any names just because it's confidentiality, but the investment amount and the EBITDA estimate in year 5 are the ones that we have in our business model. So basically, the required rate of return that we are using here is 50% per annum. I need to emphasize this is per annum. We are using a 5-year term, and the investment amount that the company wanted to raise and ultimately actually managed to collect from shareholders was 600,000 euros. So if you grow 600,000 euros by 50% per year for 5 years, the value is 4,556,250 in year 5. If you want your investment to get that type of return in the future, this is the amount of capital This is the value of your capital that you should have in the company. That's the first step. The second step is we have an operating metric estimated for year 5. So the company presented to us a business plan. The business plan said, okay, in year 5, I'm going to have an EBITDA of 3.8 million euros. And through research, the estimated multiple in year 5 was 7 times EBITDA. So to get the terminal value, we multiply 3.8 times 7, and that gives us the number 26,778,535. So that's the value of the total company. That's the enterprise value, or if the company doesn't have any cash or debt, whatever, this is the value of equity. And as a next step, we calculate the 4 million, the 4.5 as percent of the 26 million, which gives us 17% at exit. So the company is talking to us now. The founder wants to get 600,000, and we are talking about the valuation. We say, okay, for the 600,000, we want to have 17% of the company because this is what we want for our capital, and this is the terminal value that we determine. Actually, what happened in reality, we got less. The ownership that all investors got in the investment was 14%. Therefore, the company was valued according to this kind of more rational metric. The valuation of the company was higher. The difference between 14 and 17% is 22%. So the company is 22% overvalued, let's put it this way. We will discuss kind of the dynamics when we get to the questions, why is this happening? But in our case, this is exactly what happened. We paid 22% more. So this is the numerical example. I'd like to discuss a couple of other slides going forward.
Joro, in 5 minutes, you have 25 minutes altogether.
Thank you, Ellie. Okay. So this is what the investors, angel investors and professional investors need to think about when they think about the terminal value. The terminal value in our example is 5 years into the future. We are not sure whether it's going to happen, but from today's point of view, we can ask a lot of intelligence questions. Do the company's revenue forecasts make sense? Do the company's margins make sense? Is the terminal value realistic given the markets? Will anybody buy the company for this value? 26 million, who could be that buyer? The so-called exit, and so on. So these intelligent questions is important to ask them from today's point of view, thinking about the company 5 years into the future. And the final slide I'd like to comment on is the Bulgarian market. That slide feeds into the kind of my thesis that the Bulgarian market for early stage companies is very expensive. And here we see some of the reasons. There is ample supply of capital. We actually have a healthy number of startups. I am surprised that we are seeing such a large number of startups given the size of the Bulgarian economy and the population size. This is very good. We have good ecosystem with good VC managers, with good entrepreneurs that have made exits. We have good lawyers that have experience. We also have IP lawyers. We have accountants that can, and financial professionals. One thing that is missing is Series A and later stage funding. So the early stage, which always has been problematic, has been well taken care of with European funds. But the later stages are becoming problematic now. Despite the high number of companies that we see, the innovation in the IP kind of a stage is lagging. So the innovation in the companies that we see a lot of Me Too models, copycat models, if you like. The legal framework in the country is very cumbersome. The variable capital company legislation is a great step forward. Everybody is looking forward to this legislation coming into force, hopefully next year. The capital markets are very small. However, the BEAM market is making a great effort, and I think they're making a great progress. yet the capital markets, which are ultimately kind of the place to exit, to sell a successful company, is still very small. Two major problems. It's very hard to recruit the C positions for startups. We are seeing this in all of our startups, getting a chief technology officer, getting a business development officer, or getting any sort of a senior type of person is very hard to come by in Bulgaria. One thing that needs to be developed more is the link between universities and entrepreneurs. And the final one, which is kind of, what can we do with it, is Bulgaria is perceived as a high-risk country. So there are not many investors coming here and kind of actively scouting. There are people that do that, but, it could always be more. So that's the end of my presentation. The final slide are the sources that I guys encourage you to look at. And if you'd like to open, Ellie, to open the floor to questions, I'll be more than happy.
Thank you, George. Thank you for all the insights and the information you're sharing, and you're really punctual on time. Yes, I don't want to waste any more time, so guys, please raise your hand or just pop in or ask your question in the comments, in the chat here in Zoom. If you have any questions, insights, something that you agree with or you don't agree with, I think that Joro would be happy to discuss more. I know that Zdravko is very passionate about valuations, and I know that Timo is now considering an investment, and he had some questions. So yes, the floor is yours.
So I'll bring up the numerical example here just to demonstrate the fact that we had a real case where we actually paid a higher valuation. If you guys ask questions, I might discuss the dynamics why this happened, but
yes, I think one of the challenges before angels is that sometimes they don't have the negotiating power, especially if they're joining a bigger round with other venture funds and other leading investors. So I'm trying to find their place in the investment process. And
well, if a small angel investor invests 10,000 euros, and if you have a bigger investment fund investing 400,000 euros, their ideas or their incentives, their kind of valuation desires should be overlapping. However, what is happening in Bulgaria is that there is a lot of capital until this summer. The fund manager of funds in Bulgaria, which is doing a great job in kind of building out the ecosystem, has introduced, and through the European Union, has introduced really a lot of capital for the size of the economy of Bulgaria. And this leads, every fund manager has an investment period, 5 years. And through this investment period, when you're in a hurry, you have to invest them in 5 years. The valuation becomes kind of you want to get the deal done. Otherwise, negotiating, if you look at this slide, trying to get your shareholding from 17 to 14, the other way around, from 14 to 17%, it takes time. You want to make sure that the dynamic with the entrepreneur, the relationship doesn't break down. Yeah, in this particular deal, the valuation started from even higher. We were going to get like 7% of the company, not 14. So, you can consider it a success.
Kind of success, yeah.
Yeah. But the rational metrics should have been better. It's just that, you talk a couple of times, you meet, and, oh, how about this? And the founder doesn't like it, and then he goes away. And instead of wasting more time, the larger funds simply want to get on with it. I think the dynamic that we experienced was like that. We are a participant here, but we are not the largest investor in this round. There is another fund that has a large chunk of capital here.
I think Kirill has a question. Kirill?
Everyone, do you hear me, guys?
Yes.
Yeah.
I apologize for not being able to switch on my camera at the moment. So my question is as follows. I just basically met a startup the other day who were a bunch of university students, and they were huge disruptors. They're claiming they're huge disruptors, and they had a ridiculous 10 million valuation. I don't really know what they were thinking about, but I think at the end of conversation, they immediately started to rethink their approach to contacting investors. But during my conversation with them, I kind of thought about the following. At what point does your approach, George, which is a very structured and financial approach in valuing startups, interacts with the following consideration? At the end of the day, a financing for a startup is a long journey. It's not just a one-off financing, it's a long journey. And having a too low valuation in the beginning or a too high valuation actually can disrupt this financing market for the following reason. If it's too low, then the next valuation is usually hard to kind of just, let's say if it's a 2 million, next valuation is unusual to be 20 million, 10x. It's usually somewhere closer. So it might not satisfy the financing needs of the company. And if it's too high and then they cannot meet their KPIs, then you have to downsize, which we all know it's a disaster for a fundraising process. So at what point does these financial calculations have to square with the politics of it, if I may call it this way, of carrying the whole financial fundraising cycle of a company, which is from pre-seed to Series A, B, C?
Well, Kira, this is an extremely important question that you're asking, because the valuation, if you look at this slide, I kind of deliberately brought it up. This valuation is underpinned by operating metrics. If you start with a company that doesn't have any business yet, they have a business idea. And if you agree on a valuation, whatever that is, I mean, even if it is 10 million valuation, the next round, if the company hasn't met any targets, everything breaks down. Even a high valuation where the founders have a very high percentage of the company and the investors have a very small percent of the company, or the other way around, if the investor has managed to negotiate a larger chunk of the company and the company knows that he's going to want a second round, if the business doesn't perform, if the company doesn't get to this, here the example is 5 years, but you may agree with them a shorter period of time, say 2 years or 1 year. If the operating performance of the business doesn't measure up to what they have sold to the investors, everything breaks down. Otherwise, we are talking about kind of totally emotionally here, you know, we are a new company, we want 500,000, we'll give you 10%. And, you know, why 10%? And then you start discussing based on no business. But if the company reaches its milestones, then the valuation could go up dramatically. Does it make sense what I'm saying? Is because the valuation as such are not just numbers. It's not 5 or 50, you know, it's 10%. And, you know, it's based on the underpinnings of the business model. That's what I'm trying to say here. We are looking into the future, but still you have to have an underlying business performance.
Yeah, I've also seen during my legal work in the UK that sometimes actually VCs have been kind of really eager to put a higher valuation when investing, which has always kind of surprised me. Instead of negotiating for a lower valuation, they've been kind of agreeing to a higher valuation immediately. How much of this is due to the fact that probably the way the financing goes is the higher the valuation, sometimes the higher the next round? So the VC would be a happy investor because it's the first investor, and then they will be happy because the next valuation will be much higher. Do these considerations come into play? And I'm speaking not only about Bulgaria, but generally the market. Obviously the Bulgarian market is a bit peculiar in that it's highly subsidized by EU money.
It plays this kind of, I wouldn't call it a Ponzi scheme, but it looks like one.
Ballooning.
Used to work very well for two reasons. Now, when the risk-free returns was zero, okay, looking at this graph, if you look at the top one, if you invested 100 and you got nothing for the 100 going forward, you were prepared to take kind of to go down here into riskier returns with bigger capital amounts, to take the riskier profile of your investment. That's the first component. Now, the large capital allocators pension funds, insurance companies, family offices, whatnot, they have this alternative. The ship is slowly turning and they're saying, look, why do I need to bet here? I can just, have my risk-free return, which is actually quite decent. At the moment, in the US, the interest rates are actually positive. The real interest rates, that means they're higher than inflation. In Europe, not yet, but still 4%. You still you're close to keeping up with inflation, which is the major problem of large capital allocators. That's the first aspect. The second aspect is I don't know whether you guys are following SoftBank. SoftBank is a very good example of having a massive venture capital fund that was pumping up the valuations by themselves. I mean, they have this notorious example with WeWork. They did an ARM IPO a few days ago where the ARM IPO is performing the price was better than expected, but still a lot less than I think what SoftBank paid for ARM. So you have these massive, gigantic VC funds that could pump up the valuations by themselves. And so I think this phenomenon is actually coming to an end. It is still at play, but I think it's coming to an end, and everybody is making comments publicly that, just doesn't make economic sense to pay astronomical valuation, and then on the next round you pay double this astronomical valuation, for example. But the main point here is that the risk-free rate currently is going to drive a lot of changes. The tech companies that come to the market, they really need to demonstrate some efficiency for their customers. And the early stage, I mean, if I go down by, just get here. Here, in the seed stage, people will be taking careful risks. In particular, the investors participating in the seed stage will be competent. If you have experience with restaurants, for example, or if you have sold e-commerce business, the e-commerce, and you would be looking at the other e-commerce companies with very selectively, and you would know how to help them. And with the seed stage, with a capital amount, something like this, and a return profile that you seek of close to 80%, you may be able to do a portfolio of companies where you could get some decent returns going forward. But the companies that get the investment, that get the capital raised, will need to demonstrate how are they doing better than their competitors, or what is their niche, what is their value added. And the investors need to understand this.
Yes, we always recommend angels build a portfolio. I think it's a good practice. And Todor has a question. Todor, please.
Hey, hello everyone. Can you hear me?
Yes.
Yeah.
Okay. Yeah, George or Georgi. Yeah, thanks for the
Whatever.
presentation. Apologies about the camera. I'm still on holiday, not shaved in t-shirt, so I do apologize. A question though about the valuation itself. So when we have EBITDA and so on, that's fine. But how do you measure, for example, intellectual property, trademarks, even the social value of the company in a way? Because that's quite popular in the States and in Western Europe, but in Bulgaria, that's not regarded as any value, really.
These are the so-called soft factors, and what can I say? Valuing these assets, because they're assets. Right here on this example, what I'm talking about is an EBITDA. It's an operating metric. So if you have a soft asset, an immaterial asset that, you have a building which you can value, and then you have intangible asset. It's actually called intangible in English. Valuing intangible assets is always a challenge, huge challenge. If a company comes in with a patent and all they do is say, look, we have this patent, we value it at 10 million, it's exactly the same situation as the company having no patent and saying, well, I have an idea for a patent, and it's going to be worth 10 million euros. The best way how you can judge a value of an intangible asset is through the benefits that it generates for the company. Do you see any monetary benefits? So if it is a good social asset, what does it mean? Does it mean that it has lower cost of labor, lower churn of labor? Or does it charge higher prices? I'm not talking, exorbitantly higher, but still higher prices to customers. If it has a patent, does it have a licensing stream going on? Or do you need to invest another 10, 20 million into developing the production or the service behind this patent in order to make it marketable? So valuing these intangible assets is extremely hard. It becomes a subjective matter. But what I would suggest is look at the real benefits. Look at, I have this patent. How much is it going to generate for me? Does this make sense, Todor?
Yeah, absolutely. Yeah. I managed to turn on my camera. Thank you very much. Yeah. Yeah.
Sure.
Sorry to interrupt. I believe there is a method of evaluating the software and putting it into the company's balance sheet. Am I right, George?
You can do, if a company has a cost history, if a company has, let's say the founders, let's say 4 founders, typically they have put together 100,000 and they have spent 100,000 on developing this software and they have capitalized it, you could say, okay, this software is worth 100,000 on a cost value basis. You can add a premium to that. You can make it 200,000, 300,000. But typically what happens, company has invested 75,000 into software. They come to you and say, okay, the company is worth 12 million euros. And that difference between 75,000 and 12 million would be an intangible goodwill value if you were doing M&A, But here at the early stage startup, you'd say like, why? You guys invested 75,000, you need another 2 million to develop it, to get it to market. Let's reason, what can your software do? And then you go back to the operating aspects. What can you do in 5 years? What are your estimates in 5 years' time? And now you see 2 million, let's get that percent of the company going, as an ownership stake. It's what happens is quite often the dynamic of the investors and the founders. Sometimes you see very skillful founders in selling their ideas. There is always like that. You see investors that are very skillful in selling their risky investment. That's the nature of the kind of the market economy. That's okay, but kind of looking at the business rationally, trying to make sure, okay, what is exactly the business? What is the company doing? How is it making its money is essential to getting a grip on what is fair value. I just didn't put it here because the time was limited, but there is this concept of fair value. Fair value is a transaction between willing and able seller and willing and able buyer. That means a seller and a buyer meet and one says one number, the other says the same number, they agree and they transact. That's the fair value. And if you have a transaction, it means somebody paid for this, somebody asked and somebody paid for this valuation. Ultimately, that's what fair value is. What I'm suggesting here is that the market in Bulgaria, and it's not just early stage tech companies. You see this in real estate as well. You see in a lot of kind of spheres of life in Bulgaria where you have an overvaluation of all sorts of assets.
We have a question from Timo. So Timo, please.
Yeah, hi, can you hear me?
Hi, Timo, yeah.
Okay, yeah, I'm still a bit overwhelmed because it's the first time looking into company valuation. So thank you very much for the presentation. I'm trying to phrase my question. I'm looking right now into a startup who did a seed round based on the valuation of 650,000. and they're doing another round. They call it bridge round to finish the product. And the valuation is basically like 6 or 7 times higher than in the seed round. What are questions I can ask them, or what can I do in order to negotiate the valuation there? I mean, I'm already asked them the question, what did change since the seed round? And of course, we are still waiting there for the answer, and they put a couple of pieces together and need to finish a product. But for me, it seems to be quite high, that it should be like 7 times worth more than it was worth in the seed round. I'm not even sure if that's a good question. So
no, it's a good, in the sense that this happens pretty much every day, and we see situations like this every day. So thank you for asking, Timo. So I brought here the definitions of the different stages, and here in this particular paper, bridge is put at the very end. Again, these stages are just indicative, I mean, but you can have a bridge between each of the stages. So in a case they raised capital as a seed, and now they're trying to bridge up to a kind of a bigger round. In our practice, what we try to do, if you're raising a bridge round, the bridge round should be at the terms and conditions of the previous round. If you are here, okay, if you're in any of these seed startup, first and second stage. So if you're bridging any of these stages, the valuation and the conditions, because there is not just the valuation, there is also the liquidation preference. There could be some dividends, etc., etc. The bridge round typically would be at the valuation and the conditions of the previous round. Here, we have a little bit of a difference. If the company is well developed, if it has done Series B, C, or D, it has assets accumulated. So if it needs a little bit of capital to get to an IPO stage, it could be that the bridge round to bridge the company from Series B or C to an IPO, that the valuation is slightly higher. But then in such a case, you should see visibility to the IPO. It shouldn't be just, oh, we'll do an IPO in 3 years. Let's raise a bridge round at a higher valuation. You should have actually a visibility from management. In your case, I would suggest 7 times from a seed round to, to the next round, and calling it a bridge round is very aggressive. I don't know the circumstances, but it looks like very aggressive. And typically it would be, if they are raising a bridge, it should be with the old conditions. Otherwise, they need to do a brand new round and call it a round, a new round.
okay. Yep. Thank you very much.
Thank you. We have actually 3 more minutes until we need to close the event. So if somebody has a burning short question, I now thought of discussing, probably it was a good idea to discuss the convertible loan model as a way to kind of get around if there are some issues with negotiating the valuation. Maybe you can give a thought about
We can do this. We can do this in another seminar. Indeed, it becomes a little bit more scientific, if you like, because we are dealing with kind of probabilities, and it's okay. It's a legitimate valuation technique where you have optionality built in. However, the preferences of the founders, I mean, the convertible loan in Bulgaria, and again, that's the type of legislation we have. The convertible loan in Bulgaria must have market interest rates. So the safe note that is typically employed in the United States, it doesn't have an interest rate. It's a very simple instrument where you give money, you kind of let the top valuation model, and you kind of agree, whatever. I mean, basically, you can have a discount only, saying, okay, whatever money I give, 20% off the next discount, and there is just not much valuation to do there either.
Yeah.
But the legislation in Bulgaria says, okay, if you give a convertible loan, you have to have a market interest rate. And that makes it a little bit more difficult. So the optionality, the probabilities of actually a company achieving its business model, we sometimes put conditions which are not operating business related. We say, okay, in 12 months, you have to have raised a minimum of 1 million round. If you don't raise a minimum of 1 million, our conversion price gets lower, for example. So it has nothing to do with the operating aspects of the business. We are trying to cover a lot of risky aspects of the company, trying to incentivize the founder actually to deliver on what they promised. But the main thing always remains, what kind of business are we having here? Even if you're talking to a team that wants to experiment with a new product, that wants to have a product market fit, they still would be able to explain to you what is the process of getting to this product market fit. I mean, we try not to invest in companies like that. We'd like to see some revenue traction. For example, we'd like to be kind of in the middle between seed and startup stage, where there is a revenue, there is at least one paying customer who has paid, and we'd like to call this customer and ask, why did you pay for this product? What is the main thing that you liked about this product? Or do a customer interview. In this way, we try to understand, we try to go a little bit deeper into the business and see if the customer is totally ecstatic about the product. That means, it's a good one. If the customer says, I'm testing it, but I won't continue with the testing until my trial expires. So, that's a bad sign.
Yeah. I see that it's a very, very big topic, and we should try to continue it maybe during the retreat, or maybe doing another seminar online or live. But I'm sure that actually angels who are not experts maybe are a little bit overwhelmed with all the information you shared, so they need to kind of.
I encourage everybody to call me or send me an email, and then we can have a chat about this, because it's important. Like Timo, you get to see a lot of companies before we see them as investors. It's important that you guys tell them, okay, 12 million now. Let's be real. I mean, we have a lot of companies like this that come to us, and I'm just wondering, how did it come about that Bulgaria became kind of all of a sudden the value of capital? I mean, if I go back up, and this is a fundamental graph here.
And I'm sorry. Sorry to interrupt you, just to make sure that George Brashnarov didn't have a question. Do you have, George? Okay, no, it wasn't. Praise up. Sorry, George. Yeah.
I was just telling I was enjoying the last sentence of George.
But now we have this. And let me give you one personal example. I have a VC investment that I did in 2001. 2001, that is 22 years ago. I invested £2,000 in a Bulgarian company. I'm not going to name any names because they don't matter. And I sold my investment in 2019. Okay, so this was 18 years investment. This was a longer term, the long term as it gets, 18 years. I got £4,000 for my investment. So I invested £2,000. 18 years later, I got £4,000, double the money in 18 years. When you take down the IRR, it's roughly about 4%. But in these 18 years, I had 7 years of basically not knowing whether the company existed. I mean, nobody called me up. Typically, they would call up and say, okay, we have an annual report. Let's sign here, give it to the trade register. 7 years, there was nothing. None of the guys called up and I said, okay, £2,000, not a big loss. If you have this type of investment profile, you are better off doing this at the moment, doing a risk-free investment, putting your money in US treasuries. You have some risk, currency risk or whatever, inflation, whatever. And then see your money every year, how much they grow, rather than try to wait for 18 years and then all of a sudden get a phone call from a friend and say, look, I'll buy your shares. And then you feel happy because, hey, that's kind of, this is the rational way. This is the very rational way. What plays into our way of life of investing is just the fun. You want to give money to a company, you want to be in touch with the founders, see what's going on. If you lose your money, no big deal. 1, 2, 3 times, that's fine. But if like none of your investments return money, then it becomes a problem. Okay, well,
Yes,
I
thank you.
have to wrap it up.
I know. Thank you very much for sharing your know-how, for the presentation, for your time. And we sure will continue the conversation, and I will send the video recording to the whole group. So yes, have a good night, everyone.
Thank you
Bye.
very much, Eli. Good to see everyone. Please send me emails, call me. It would be
Thank
great
you.
to discuss.
Great. Thank you very much.
Thanks. Bye-bye.
Bye, guys.
Thank you
Bye
very
bye.
much.